This is Part 2, Chapter 17 on pensions. Now what we're going to do is go through how to determine employer's obligation, which is planned benefit obligation, also known as PBO, and then how to determine the plan assets. And we'll go through the journal entries and we'll review again the pension expense. Again, we have three elements defining a benefit pension plan. We have to determine the employer's obligation. This is the PBO. We have to set aside the assets to cover the obligation. And then we have a periodic expense, which is called pension expense, which is the cost of servicing this plan. Now, projected benefit obligation. It estimates the retirement benefits by applying the pension formula using projected future compensation levels. Less reliable but more relevant and representational, faithful representation, and this is the measurement of the pension liability used to report amounts in the balance sheet and the income statement. Now what we're going to do is we're going to work through an example, and we're going to determine the pension obligation, the plan assets, and the pension expense. And I'll show you how to determine it, and then I'll also show you the journal entries, because that's the same as that's in your homework. So remember, the reason I do these presentations is because I want to help you when you go to do the homework. All right, here we have an example. Mike Corporation has a defined benefit pension plan in millions. We see our planned benefit obligation has a beginning balance of $480 million. We have plan assets of $300. We already know it's underfunded. Then they tell us the service cost, the interest costs, gain from changes in actuarial assumption, benefit paid, actual return on assets, and the contribution for 2018. They also tell us that the expected long-term rate of return on the plan assets had been 8%. So if we were to take 8% times 3, we can see that what we should have earned is $24,000, and what did we earn? We actually only earned 20, so we had a loss on that. There is no accumulated other comprehensive income, and the balance related to the pension on January 1st, but by the end of 2018, the planned pension formula was amended, creating a service cost of $12 million. Now, what are the components that create a change in the PBO? Well, we're going to add to it the service cost, the interest cost, which is a discounted rate on the projected benefit obligation, plus prior service costs, plus losses minus gains. Losses increase the obligation, gains reduce the obligation, and then we have to reduce it by any benefits that were paid out. So now let's take a look at our problem. Now we know we started, the PBO started with a balance of $480 million. The service cost which they provide is $75 million. The interest cost, which they show on the plan, is $45 million. The prior service cost is $12 million. They tell us that in the problem. We have a loss, but in our case, we have a gain from change in actuarial assumptions, so we're going to subtract that out because it reduces our obligation. And then we have to subtract out any prior payments. So our ending balance in our planned benefit obligation should be $554 million at the end of the year. Now, our plan asset account. We start with a beginning balance. We add to it expected return on plan assets, adjusted for actual return. So we have to remember there's always that adjustment. So if we expected a return that is less than actual, then that's going to help our plan. And if we expected a return higher than we actually received, that is going to be a reduction in what we have for our plan assets. Then we're going to add to it any contributions, and we're going to subtract out retiree benefits paid during the year. So in our example, our plan started at $300 million. We have return on assets, and it is always our expected return, which is 24. The difference of the actual versus the expected, we had actual of 20, we expected 24, so we actually had a loss to other comprehensive income of $4 million. We contributed $60 million, and the benefits paid out was 36, so the ending balance in our plan is $344 million. Now, based on this, we are underfunded by $210 million. Which is the difference between the obligation and the balance in the fund. And that's what's going to appear on the balance sheet. Now, components of pension expense, we talked about this previously. We've got our service cost, our interest cost, minus any returns based on expected, prior service cost, and any loss or gains in revisions of the pension plan. So now we can go through and do our calculation. We have our service cost of 75, our interest cost of 45, return on plan assets, remember we always use the expected return. Prior service cost, there is no prior year accumulated other comprehensive gain or loss, so no amortization. And amortization of gain, the gain of 22 is less than 10% of the 480 in the plan benefit obligation, which is higher, which means that we don't have to do any amortization. So our pension expense is $96 million. Now what we'll do is we'll go through and do our journals, and we'll also look at our T accounts to see that we end up with these ending balances. Now, the T accounts for our journal entries. For the PBO, we had a beginning balance of 480, and we calculated an ending balance of 554. So our journal entries should give us that ending balance. And for the planned assets, we have a beginning balance of 300, ending balance of 344. So now we're going to go through and do our journal entries. We're going to record our pension expense. We're going to debit $96 million. Plan assets, we're going to book our expected return, and the plan benefit obligation is going to get the service cost plus the interest. We're going to record our prior service cost. It is going to go to other comprehensive income, and it's going to increase our PBO. Now we'll do our T accounts, and we show those entries, and now we'll go and do our other entries. Now, we're going to record the gain or loss on PBO or planned assets. We had a gain, which reduced our obligation, and we had a loss, which is the difference between the expected and the actual return, which reduces our plan assets. Then we're going to record our contribution, and then we're going to record our payout. Now, this is what ends up. So if we take our 480 plus the 120 plus the 12 minus the 22 minus the 36, you will get the 554 ending balance. For planned assets, if you take your 300 plus your 24 plus your contributions minus your loss minus your benefits paid out, you get 344. That concludes the presentation on Part 2 on pensions. I hope that helps, and this should help you with your homework.